Can AI really build the perfect investment portfolio for beginners, especially for us here in Southeast Asia? I was skeptical, so I put it to the test. Most investment advice you find online is super use-focused. It talks about 401 kiloseconds and platforms we can't even access. It completely ignores our local realities, like our currencies, the Malaysian ringgit, Singapore dollar, or Indonesian rupiah. It doesn't consider things like CPF, EPF, or ASNB. And let's be real, our cost of living, risk tolerance, and access to ETFs are totally different. So I decided to challenge several AI tools to build a realistic, low-risk portfolio specifically for a beginner in Southeast Asia. I gave it a clear set of rules. It had to be based on a typical beginner's income, use platforms actually available to us, focus on long-term wealth building, and prioritize low fees and diversification. The results were genuinely eye-opening, and I'm going to share everything with you. In this video, you'll learn exactly how AI analyzes risk tolerance for a complete beginner. We'll explore the best asset allocation mix AI recommends for someone in Malaysia, Singapore, or Indonesia. We'll also settle the big debate, stocks versus ETFs versus robo-advisors. What does AI think is best for getting started? And most importantly, I'm going to walk you through a sample portfolio that AI built, step by step, so you can see exactly what it looks like and understand the logic behind it. This video is for all my fellow Southeast Asians who are ready to start their investing journey but feel a little lost. Whether you're a student, a young professional, or just someone who wants to build long-term wealth without all the stress and confusion, this is for you. We'll cover how you can start investing with just a small amount each month and uncover the most common mistakes beginners in our region make so you can avoid them. First, let's talk about risk. Before you invest a single dollar, you need to understand your own risk tolerance. This is where AI really shines for beginners. Instead of a generic questionnaire, I used AI risk profiling systems that ask more intuitive questions. It's not just about your age or income. It's about how you'd react if the market suddenly dropped 20%. Would you panic sell, or would you see it as a buying opportunity? The AI analyzes your answers to create a personalized risk profile. For a typical beginner in their 20s or 30s in seed, the AI usually recommends a growth or balanced growth profile. This means you're willing to take on a bit more risk for higher potential returns over the long term, because you have time on your side to recover from any market downturns. This is a crucial first step because your risk profile dictates your entire asset allocation strategy. Getting this wrong is one of the biggest mistakes new investors make. They either take on way too much risk and get scared away, or they're too conservative and their money barely grows. So once the AI has figured out your risk profile, what's next? Asset allocation. This just means how you split your money between different types of investments, like stocks and bonds. For a Southeast Asian beginner with a balanced growth profile, a common AI recommendation I saw was an 80-20th split. That means 80% of your portfolio goes into stocks or equities, which are the engine for growth, and 20% goes into bonds or other fixed income assets, which provide stability and act as a cushion during market volatility. But here's where it gets really interesting and specific to our region. For the 80% in stocks, the AI didn't just say buy the S&P 500, it was smarter than that. It recommended a diversified mix. A large chunk, maybe 40 to 50%, would go into a broad global stock ETF, like one that tracks the MSCI World Index. This gives you exposure to thousands of companies worldwide, from the US to Europe to Japan. Then it suggested adding about 20 to 30% into an ETF that focuses specifically on Asia or emerging markets, which includes our own powerhouse economies right here in Southeast Asia. This is the key. It ensures your portfolio isn't just riding on the US market, but is also benefiting from the growth happening in our backyard. The remaining 10% in stocks could then be allocated to a local country-specific ETF. For example, if you're in Malaysia, an ETF tracking the top 30 companies on the KLCI. If you're in Singapore, one that tracks the Straits Times Index. This gives you a home country bias, which can be good for currency reasons and for investing in companies you know and understand. Now for the 20% in bonds. The AI suggested local bond ETFs. So, for a Malaysian investor, it would be a Malaysian government or corporate bond ETF. Why local? Because it helps reduce currency risk. If you invest in US bonds, your returns can be wiped out if the US dollar weakens against your local currency. By keeping your safe assets in your home currency, you add another layer of stability to your portfolio. This level of detail is something you rarely get from generic advice. The AI understood the importance of global diversification, regional growth, and local stability. This is a solid, diversified foundation that's built for the long haul. Okay, we have our asset allocation, but how do we actually buy these things? This leads to the next big question. Individual stocks, ETFs, or robo-advisors. I asked ChatGPT to weigh in, based on the goal of low-stress, long-term investing for a beginner. The verdict was overwhelmingly clear. For most beginners, the best starting point is a combination of ETFs and robo-advisors. Let's break down why. Picking individual stocks is incredibly difficult and time-consuming. You need to do deep research on each company, and even then, you could be wrong. For every success story, there are countless people who lost money trying to pick the next big thing. It's high risk and high stress. ETFs, or exchange-traded funds, solve this problem. An ETF is a basket of hundreds or even thousands of stocks or bonds in a single investment. When you buy one share of a global stock ETF, you instantly own a tiny piece of Apple, Microsoft, Samsung, and thousands of other companies. It's instant diversification. It's low cost, and it has the strategy recommended by legendary investors like Warren Buffett for the vast majority of people. So, where do robo-advisors fit in? Robo-advisors are platforms that use algorithms, a form of AI, to do all of this for you. Platforms popular in our region like Stashaway, Watt, or Scythe will ask you questions to determine your risk profile, and then they automatically build and manage a diversified portfolio of ETFs for you. They handle the rebalancing, the dividend reinvesting, everything. It's the ultimate set-it-and-forget-it approach. The AIS verdict was that for someone who wants to be completely hands-off, a robo-advisor is the perfect entry point. For someone who wants a little more control but still wants simplicity, buying a few core ETFs on their own through a brokerage is the way to go. So let's put it all together. What does a sample AI-built portfolio look like in practice for a beginner in, say, Malaysia, with 500 ringgit a month to invest? First, the AI would suggest opening an account with a low-cost platform. This could be a robo-advisor or a brokerage that offers access to the right ETFs. If you choose the robo-advisor route, the process is simple. You sign up, answer the risk questionnaire, and the platform suggests a portfolio, maybe a growth one with an 80% stock and 20% bond allocation. You just set up a recurring monthly deposit of 500 ringgit, and the robo-advisor does the rest. It will automatically buy the ETFs for you in the right proportions. It's that easy. If you prefer the DIY ETF route, the AIS logic would suggest this plan. First, open a brokerage account. Then, with your 500 ringgit, you'd allocate your funds according to the 80/20ths model we discussed. So 400 ringgit goes to stocks and 100 ringgit to bonds. With that 400 ringgit for stocks, you could put 250 into a global stock ETF, like one tracking the MSCI World Index. Then put 150 into an Asian or emerging market ETF. For the 100 ringgit for bonds, you'd buy a Malaysian bond ETF. Now you might not be able to buy all of these every single month with a small amount. So a practical approach the AI suggested is to alternate. Month 1, you put the full 500 into the global ETF. Month 2, you put it into the Asia ETF. Month 3, the bond ETF, and then you repeat. Over time, you will build up a portfolio that matches your target allocation. This strategy, known as dollar cost averaging, is perfect for beginners because you're investing a fixed amount regularly, regardless of what the market is doing. The key takeaway from the AI's analysis is this. The perfect portfolio for a beginner is not about finding a secret stock pick. It's about consistency, diversification, and keeping costs low. It's a boring strategy, and that's why it works so well. AI is great at this because it operates on pure logic and data, removing the emotion that causes so many investors to make bad decisions, like panic selling during a downturn or chasing hype. By leveraging these AI-powered tools and strategies, you can automate your investing decisions and build a robust portfolio tailored to your life here in Southeast Asia. You don't need a finance degree or a huge amount of money to start. You just need a solid plan and the discipline to stick with it. AI can give you that plan. Your job is to take the first step. Thank you so much for watching. I hope this gave you a clear, actionable roadmap to start your investing journey. If you found this helpful, please give this video a thumbs up and consider subscribing for more content on personal finance and investing for us in Southeast Asia. Let me know in the comments which AI tools you are curious about, or if you have any questions. See you in the next one. Check out my pinned comment and vote on what AI should create next.